Have you ever felt anxious about money after watching the news? Or maybe you've made investment decisions after reading something online or hearing the latest prediction from a market expert on CNN. If that sounds familiar, you're not alone. But you need to understand that financial media does not have your best interests at heart. In fact, a lot of the time, they're leading you straight into financial traps. If you're new to the channel, I'm Adam. I'm a chartered financial planner, and I help people to make better financial decisions. So if you want to learn more about personal finance and investing from a qualified source, then hit subscribe for more bite-sized videos. Today, I'm going to explain 4 key things you need to know about the financial media and how it can derail your financial success. And then I'll finish with some things you can do to stop that from happening. First, let's talk about the business model. The primary goal of most financial media outlets is not to help you make smart decisions or become a successful investor. It's to keep you engaged. Like any other media company, financial media outlets rely on ratings, viewership, and ad revenue. They need you to click, watch, and react. And how do they achieve that? By creating a sense of urgency, fear, and excitement. Exactly the kind of feelings that lead to rushed, emotional, and ultimately bad financial decisions. So remember, their job is not to give you sound financial advice, it's to get you to tune in again tomorrow. Now imagine if they posted this headline every day for 5 straight years. No one would keep watching. So instead, they bombard you with short-term news, sensationalized headlines, and market predictions, all of which are irrelevant to your long-term goals. The reality is, building wealth and achieving financial freedom is a long-term process, and reacting to daily news will only distract you from that, blow you off course, and probably set you back years. How often have you seen a so-called expert appear in the media making bold predictions about the market? Whether it's forecasting the next crash, predicting the next market rally, or hyping up the next big stock, these predictions rarely come true. The truth is, nobody has a crystal ball, and anyone telling you they can predict the future is either lying or guessing, and someone doing either of those two things is not someone you should be listening to. Yet, the financial media loves these unreliable sound bites because they generate views. Here's a classic example. Jim Cramer is the host of Mad Money, which is a show on CNBC that attracts hundreds of thousands of views every day. So millions and millions of people watch this show. Yet in 2008, he very confidently told viewers that Bear Stearns was absolutely fine and they shouldn't take their money out of the company, even going so far as to say that doing so would be silly.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. If there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly. Mad Money's back after the break.
6 days later, Bear Stearns went bankrupt and helped trigger the 2008 global financial crisis. You have to remember that your objectives and the media's objectives are not aligned. You want to make good financial decisions for your future. Media outlets want to generate headlines and sound bites for today. So to put this another way, if you base your financial decisions on what these so-called experts are shouting about, then you're basing your decisions on information that is quite simply not relevant to you or what you are trying to achieve in the future. And basing your financial decisions on what these experts say is risky because they aren't accountable for the outcomes. These experts are often not qualified professionals, their opinions aren't financial advice, and they take no responsibility for the impact of their words. So if things go wrong, then you'll be left holding the bag while they'll be back the next day generating the next headline. Financial media thrives on amplifying the emotions of fear and greed. When markets are down, the headlines scream recession, sell everything. And when markets are up, you see stories about people becoming overnight millionaires. This taps into 2 powerful emotions, fear and greed, and drives us to act impulsively, usually to our detriment. When the media plays on fear, we panic and we sell our investments, often leading to losses. And when they hype up the next big thing, we chase trends, again, often leading to losses. And this is a well-known psychological phenomenon. Behavioral economists call it herd mentality or following the crowd. We just can't help it sometimes. But real wealth is built through disciplined, long-term investing, not by reacting to emotional cycles. And remember, you should only make changes to your investments when your personal or financial circumstances change or when your goals change. If you're making decisions for any other reason, take a step back and think through your choices logically before you make a big mistake. Financial media outlets often rely on clickbait articles, especially online. You've probably seen some articles titled something like 5 stocks you must buy now, or is the market about to crash? These titles play on our curiosity and emotions and get us to click, but the content itself rarely offers any substantial value. Another problem is bias. Some media outlets promote products or services purely because they're sponsored by the companies behind them. You may think you're getting objective information, but you're actually being nudged towards a specific product. So be wary of content that promotes specific products or services. And this is even worse on social media, where influencers often promote products or services that they just don't understand. They aren't bound by qualifications, professional standards, or regulations, and they have no accountability for the outcomes if unsuspecting viewers follow their guidance. So, how do you protect yourself from falling into the traps set by financial media? Well, first, recognize that most of what you see is just noise. The best strategy for long-term investors is to tune out the day-to-day drama and focus on the big picture. Turn off the 24-hour news cycle, stop checking your portfolio every hour, stay focused on the goals that you're trying to achieve and the well-thought-out plan that you've mapped out to achieve them. Invest early and often, and think in decades, not days. Remember, time in the market beats timing the market every time. This is how you stay on track, stay ahead, and prevent financial media outlets from manipulating your emotions and blowing you off course. Remember, no one on TV, in the newspaper, or on social media is going to care about your financial future as much as you do. So take control of your own finances and your own financial future, educate yourself, and make informed decisions that will benefit you and not media outlets. Thanks for watching, and if you found this helpful, make sure to like and subscribe. Hit the notification bell for more videos on mastering your finances. See you soon.